no fewer than 4 central banks will unveil their latest monetary policy decisions in the coming week. The Bank of Japan and the US Federal Reserve on Wednesday the 22nd of September will be followed by the Swiss National Bank and the Bank of England on Thursday the 23rd. Not one of them is expected to raise interest rates from current levels, even if Russia's 5th rate rise of the year and Korea and Iceland's 1st mean we now have seen 51 individual rate rises from central banks in 2021 to date. That compares to just 8 cuts, according to www.cbrates.com. Now, those who have raised rates have generally cited inflation. The quartet that we're about to look at, well, they seem to be in the camp that current spikes in prices are, yes, transitory, and the result of post-pandemic bottlenecks rather than longer-term and potentially longer-lasting trends, like onshoring of global supply chains, limited investment in oil, tight labour markets, and also rampant money supply growth. For the record, the headline base rates are minus 0.75% in Switzerland, minus 0.1% in Japan, plus 0.1% in the UK, and plus 0.25% in the USA. Now, if there's no rate excitement expected, the real focus of economists and investors will be on any comments about these 4 central banks' respective quantitative easing or QE policies. The SNB continues to run QE full tilt to, in its words, stop the Swiss franc from appreciating and therefore damaging the Swiss economy. The Bank of Japan is officially running QE at the rate of 80 trillion yen, or £526 billion a year, but its balance sheet has almost stopped growing in what could be seen as a stealth taper. The Bank of England expanded its total QE programme to £895 billion last November, but said it has eased the pace of its bond purchases. And the US Federal Reserve's flat out at $120 billion a month, with markets pricing in a move to taper or reduce that amount perhaps in November. The net result of all of this policy activity is that the quartet's aggregate balance sheet currently comes to just over $16 trillion, or 10% higher than a year ago, 62% higher than just 2 years ago, and more than treble what it was 10 years ago. That begs the question of what happens if they do try to stop adding to QE, let alone withdraw some of it, as it no longer feels like the emergency measure that it was in 2008-9 is now an emergency measure. Prior attempts at tightening policy haven't lasted long either, maybe because economies or financial markets have wobbled, or both. But if inflation does take off, central banks might have to tighten policy, whether they like it or not. Now, it's going to be busy on the corporate front too, as there's a decent list of scheduled announcements from large, mid, and primarily small cap stocks coming up. Names which may be worthy of further research include the following, although do please note that some of these dates could yet be subject to change. Finsbury Food on Monday the 20th of September, Craneware, Dignity and SIG on the 21st, PZ Cussons, Saga and Strix on the 22nd, CVS, DFS Furniture and Anglo-Asian Mining on the 23rd, before Trufin and an analyst meeting at 7 Trent round off the week on Friday the 24th of September. But for me, the company which could just cause the biggest fuss in the week ahead is Kingfisher. The DIY retailer is due to report its first half or interim results on Tuesday the 21st of September. Kingfisher owns B&Q and Screwfix in the UK, Castorama and Brico Dépôt in France and across Europe, and its shares are a quarter higher than they were a year ago, even if they stand a little below their summer's highs. The ongoing DIY boom is one possible explanation for this, and good progress in Chief Executive Officer Thierry Garnier's powered by Kingfisher turnaround plan, well, that may be another. In addition, Monsieur Garnier raised his sales forecast for the first half-year period for the second time, alongside the second quarter trading statement in July. He also increased profit forecasts for good measure. In that July update, Monsieur Garnier flagged a 1.3% drop in like-for-like second quarter sales after the first quarter's 64% gain. This means that the first half will come in some 22% higher. And as a result, Kingfisher now expects first half adjusted pre-tax profit of between 645 and 660 million against 415 million a year ago. Now, when it comes to the interims, therefore, analysts will home in on 4 sets of figures. The first is any guidance for sales for the second half of the year to January 2022, and whether the third and fourth quarters will be able to show positive like-for-likes against a very tough base for comparison. Analysts are currently looking for the second half like-for-like down in total of 6.6%, and that will leave like-for-like sales for the full year down by just under 2%. Analysts will then delve into the geographic sales trends. Sales in the UK and Ireland, Romania and Spain were up in Q2, but France was down, and e-commerce was finally cooling a touch after a barnstorming run. And attention will then switch to checking out adjusted pre-tax profit against guidance for the first half, but investors will be more interested to see if Monsieur Garnier gives a steer for the whole year. The current consensus forecast is £913 million against £786 million last year, before a drop in the year to January 2023, perhaps as DIY ardor cools and consumers can, hopefully, get out of the house a bit more. The last headline figure to come under scrutiny will be the dividend. A run of 9 straight increases in the annual payment came to an end in the year to January 2019, and Kingfisher even cancelled its final dividend for January 2020 as the pandemic began to take hold. Nor did the FTSE 100 member pay an interim dividend last year, but it then weighed in with a final payment of 8.25 pence a share. For the fiscal year as a whole, analysts are looking for 11.2p a share this time around, so it seems likely the company will declare an interim payment. Shareholders and analysts will then look for an update on the Powered by Kingfisher plan and the financial priorities outlined by the Chief Executive, Monsieur Garnier, as part of the programme, which are 1. Sales growth faster than the overall market, 2. Profit growth in line with and then faster than sales growth, and 3. Strong free cash flow. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.